Welcome to Module 3, Basic Options Strategies. In this module, we have 3 learning objectives. First, identify the setup and market outlook for foundational strategies. Second, analyze risk and reward using payoff diagrams. And third, apply strategies to real-world Nifty 50 data. By the end of this session, you will be able to construct and analyze 5 core strategies: the covered call, the protective put, straddles and strangles, and vertical spreads. For each strategy, we will follow a consistent 4-step framework: the setup, the market view, the risk-reward profile, and a real-world example using actual Nifty 50 prices. Whether you are looking to generate income, protect your portfolio, or trade volatility, these tools form the building blocks of professional trading. Let's dive in. Our first strategy is the covered call. This is a staple for investors who want to generate extra income from their long-term holdings. The setup is simple. You own the underlying asset and sell a call option against it. We typically select a strike price that is out of the money, meaning it is higher than the current market price. You use this when you expect the market to stay relatively flat or rise only slightly. You are happy to collect the option premium as rent on your stocks. Notice the payoff diagram. Your upside is capped at the strike price. If the stock moons, you do not participate in the gains beyond that point because you are obligated to sell. However, the premium you collected provides a small buffer against a price drop, lowering your effective cost basis. Let's look at a real-world example using the Nifty 50. Suppose Nifty is trading at 24,320. You are long the index but think it will not cross 24,800 this month. You sell that call option for a premium of 145 rupees. Your maximum profit occurs if Nifty reaches or exceeds 24,800. You make 480 points from the index move, plus the 145 points of premium you kept. Your break-even point is now lower at 24,175. If Nifty stays flat at 24,320, you still profit by the full premium amount. The trade-off? If Nifty shoots up to 26,000, you still only walk away with 625 points of profit. You've capped your upside in exchange for immediate income. Next, we move to the protective put. If the covered call is about generating rent, the protective put is all about insurance. The setup involves owning the underlying asset and buying a put option. We usually select a strike price slightly below the current market price. Think of this as your deductible in an insurance policy. You use this when you are long-term bullish but expect high volatility or a potential crash in the short term, such as during an earnings announcement or a major geopolitical event. Look at the payoff chart. No matter how far the market falls, your losses stop at the put's strike price. To the upside, you still participate in the rally, though your total profit is reduced by the premium or cost you paid for the insurance. It turns a potentially unlimited risk into a strictly defined one. Let's apply this to a real Nifty scenario. Imagine you hold a portfolio tracking the Nifty and you want to protect it against a sudden correction. With Nifty at 24,320, you decide to buy the 24,000 strike put for a premium of 180 rupees. This is your insurance cost. Let's look at the payoff diagram. The flat line on the left represents your floor, while the rising line on the right shows your capped but participating upside. Your deductible is the distance between the current price and your strike, which is 320 points, plus the 180 points you paid for the option. This means the absolute most you can lose is 500 points, even if Nifty crashes to zero. Per lot of 50, that is 25,000 rupees. If the market rallies to 25,000, you gain 680 points on your holdings, but you subtract the 180 points spent on the put. Your net profit is 500 points. You've traded a small portion of your gains for the peace of mind that your downside is completely floor protected. This is a classic sleep well at night strategy. Now we move into the world of pure volatility trading with the long straddle and the long strangle. These strategies are unique because you don't care which way the market moves. You just need it to move a lot. The setup for a straddle is buying both a call and a put at the same strike price. usually right where the market is currently trading. For a strangle, you buy a call at a higher strike and a put at a lower strike. This makes the strangle cheaper to enter, but the market has to move even further for you to profit. Notice the payoff diagrams. The straddle creates a sharp V shape. If the market stays flat, you lose your premium as time passes. For a strangle, it's a flat-bottomed U or cradle shape. You use these before major events like the Union Budget Day, election results, or central bank interest rate decisions. But if the market explodes in either direction, one of your options will gain value much faster than the other loses it, leading to potentially massive profits. Let's look at how these volatility plays look with actual Nifty prices ahead of a major news event. For the straddle, you pay 600 points total. For the strangle, you pay significantly less, only 270 points. To profit on the straddle, Nifty must move more than 600 points in either direction. The break-even points are 23,720, 4,900. If Nifty finishes at 25,000, your call is worth 700 points, and since you paid 600, you make a 100-point profit. The strangle is cheaper, which means your maximum loss is smaller if the market stays dead quiet. For the strangle, the break-evens are 23,730 and 24,870. However, look at the gap. The market has to move much further to cross the outer strikes of the strangle before you even begin to make back your premium. Traders choose the straddle for maximum sensitivity to movement, and the strangle for a lower-cost lottery ticket play on extreme moves. Our next strategy is the bull call spread. This is a vertical spread designed for traders who have a directional bias but want to trade more efficiently than simply buying a call. The setup involves two legs. You buy an at-the-money call to catch the upside, but you simultaneously sell an out-of-the-money call at a higher strike price. Selling that higher call generates a premium that offsets the cost of the call you bought. You use this when you expect the market to go up, but you don't expect a massive vertical moonshot. By selling the out-of-the-money call, you are essentially saying, I think it will go up, but probably not past this specific level. Look at the payoff diagram. It has a stair-step shape. It starts at a loss, rises through the break-even, and then caps out at the higher strike. Compare this to a simple long call. The bull call spread costs much less to enter and has a lower break-even point. The trade-off, as with the covered call, is that your profit is capped. If Nifty rallies far beyond your sold strike, you don't make any extra money. It's a trade designed for steady, high-probability directional moves. Let's look at a Nifty example to see the cost efficiency of a bull call spread in action. Suppose the Nifty spot price is 24,320. We buy a 24,300 call at a 320-point premium and sell a 24,600 call at a 140-point premium. This brings our net cost down to 180 points. If you just bought the 24,300 call, you would pay 320 points. By selling the 24,600 call against it, your total cost drops to just 180 points. Your maximum loss is now limited to 9,000 rupees per lot, compared to 16,000 if you had just bought the call. Notice the break-even point. For the naked call to be profitable at expiry, Nifty needs to reach 24,620. For the spread, Nifty only needs to reach 24,480. You've significantly increased your probability of profit by capping your potential gains. This is a professional way to play a moderate bullish move without overpaying for time value. For the best trading experience, optimize and analyze your live trades on the Dawn app. Use referral code EJZZI96380 to open your account. Finally, we have the mirror image of our previous strategy, the bear put spread. This is the go-to strategy for a defined risk bearish play. The setup involves buying a put option to profit from a price drop and selling a lower strike put to finance the purchase. This vertical arrangement limits both your cost and your maximum potential profit. You use this when you expect the market to fall, perhaps due to a poor earnings report or a breakdown in technical support levels. but you do not anticipate a complete market meltdown. The payoff diagram shows that if the market stays high or rallies, you lose the net premium you paid. As the market falls, you move into profit until you hit the strike of the put you sold. Beyond that point, your profit is locked in and does not increase further. It is a much cheaper way to bet against the market than buying a naked put, especially when implied volatility is high and options are expensive. Let's calculate the numbers for a bear put spread using current Nifty data to see how it protects your capital while betting on a downturn. The current Nifty spot price is 24,320. Buying the 24,300 put outright would cost you 280 points. By selling the 24,000 strike put at 130 points, you reduce your total trade cost to 150 points. In this specific setup, you have a 1-to-1 risk-reward ratio. You are risking 7,500 rupees to potentially make 7,500 rupees. The advantage is clear when you look at the break-even. If you only bought the put, Nifty would need to drop below 24,020 for you to see a single rupee of profit. With the spread, you start profiting as soon as Nifty drops below 24,150. By accepting a cap on your profit at the 24,000 level, you've made it much easier for the trade to become profitable, and you've nearly halved your initial risk. We have now covered the 5 essential building blocks of options trading. Let us recap what we have learned and how these strategies fit into your trading toolkit. We started with the covered call, using it to generate income on Nifty holdings by capping our upside gain. We then looked at the protective put, which acts as an insurance policy, ensuring that no matter how far Nifty falls, our losses are strictly limited. For times of high uncertainty, like budget days, we explored the Straddle and Strangle, where we profit from big moves regardless of direction. Finally, we examined vertical spreads, the bull call, and bear put spreads, which allow us to take directional bets with lower costs. Open your Dawn app and use the strategy builder to model these nifty examples. Observe how theta, or time decay, affects these positions over a few days. Remember, the key to professional trading is not just picking the right direction. It is picking the right structure for your market view. Practice modeling these on the Dawn app, using real Nifty prices to see how the Greeks and time decay impact your payoff in real time. In the next module, we will move beyond these basic strategies to look at more advanced income strategies like iron condors and butterflies.